Thank you for the invitation and the kind introduction. It is a great honor to participate in this prestigious event together with policymakers and representatives of the private sector and universities from Central and Eastern Europe. In my remarks, I will briefly discuss the outlook for Europe and highlight the crucial role that policies have played to limit the damage of the pandemic and will have to play in the recovery. Given today's panel, I will discuss monetary and corporate sector policies in greater detail. Let's go straight to our forecast. To say that last year was extremely difficult is an understatement. In Europe, the pandemic exacted a heavy toll with more than 480,000 people losing their lives and millions suffering illness or losing loved ones. Daily lives were disrupted by restrictions and livelihoods were severely impacted. The lockdowns of March and April and the voluntary social distancing led to a fall in GDP of about 10% in the second quarter of 2020 compared to the first quarter. This decline was 3 times steeper than that during the global financial crisis. Hospitality, travel, tourism, and sectors with complex value chains such as electronics and automobiles suffered the most. Advanced European economies experienced a much deeper fall in activity than emerging European economies. These were caught later by the pandemic and they reacted earlier to the spread of the virus. After the record contraction in the second quarter, economic activity rebounded strongly in the third quarter of last year. This snapback to economic activity to near normal levels reflected the success of policies, which we will discuss in a minute. Now to 2021. In our forecasts of last October, we projected a rebound in GDP of close to 5% after an estimated contraction of 7% in 2020. Since then, several risks have materialized, both on the downside, a stronger second wave, and to the upside, the unveiling of several vaccines that may prove effective in combating the virus. We are in the process of updating our forecast to account for these events. What is clear, though, is that the uncertainty surrounding economic projections will continue to be very large. Let me now turn to the policies. The exceptionally strong policy response played a crucial role in cushioning the pandemic's impact. Fiscal support has been unprecedented, with large discretionary fiscal packages being added to sizable automatic stabilizers. Both advanced and emerging European economies deployed programs aimed at protecting people, jobs, and businesses, including by expanding social safety nets. The cost of the policy response, combined with falling revenues, led to a surge in budget deficits. We estimate that in 2020, primary balances declined by about 10 percentage points of GDP in advanced European economies and 6 percentage points of GDP in emerging European economies. The policy response was appropriately geared towards protecting the structure of the economy and the fabric of society. One important feature of the policy response was that a large share of the fiscal packages announced in 2020 was used for job retention schemes. These schemes have been highly successful in protecting jobs and livelihoods. They maintained the link between workers and firms and provided income. In almost all countries, a much larger share of the adjustment has happened through lower hours worked per worker rather than through an increase in unemployment. These programs have estimated to have reached at least 54 million jobs, which is a truly large number. Our analysis of the impact of national fiscal packages suggests that output losses in 2020 could have been 3 to 4 percentage points larger without the timely and sizable fiscal support. Moreover, monetary and macroprudential easing instilled confidence and helped keep credit flowing, while corporate sector policies provided aid to firms to ensure that disruptions caused by the outbreak do not undermine their viability. Since many of today's panels will explore the implications of the pandemic for monetary policy and the corporate sector, I will discuss these policies in more detail. Besides cutting policy rates where possible, central banks across the region resorted to unconventional monetary policy. On the one hand, the ECB expanded its balance sheet by more than 15 percentage points of GDP with respect to end 2019. It also strengthened its support to central banks of non-euro area countries with new bilateral swap and repo lines. More generally, the large policy response in reserve currency economies eased global financial conditions and created the conditions for more active policies in emerging economies. In this regard, 6 emerging European countries, Croatia, Hungary, Poland, Romania, Serbia, and Turkey, engaged in asset purchasing programs for the first time. The primary goals of these programs have been to stabilize the functioning of bond markets, strengthen the monetary policy transmission mechanism at longer maturities, and provide liquidity to the financial sector. Compared to reserve currency countries, the size of asset purchases in emerging Europe was modest. While the composition of asset purchases differs across countries, central banks engaged in secondary market asset purchases of government or government-guaranteed securities. In most cases, the central bank's monetary base did not increase in proportion to asset purchases because they were sterilized like in Hungary or Poland. While it is too early to assess the medium-term effects of these programs, they appear to have maintained orderly market conditions. Our analysis suggests that these programs moderated the increase in government bond yields, if slightly, and cushioned the outflows of foreign investors from treasury markets, thus stabilizing domestic government bond markets. Remarkably, these policies have not resulted in large decreases of international reserves or exchange rate depreciations, as they were implemented against the backdrop of very weak domestic demand and highly accommodative global monetary conditions. We believe that these favorable outcomes were a result of the following. First, these policies had a sound objective, that is, to preserve market functioning. Second, this objective did not interfere with central banks' main objective of ensuring price stability. And third, asset purchases were effected in secondary rather than primary bond markets and thereby limited disrupting the price discovery process. Now let's move to the corporate sector policies. They were introduced to preserve the structure of the economy by seeking to avoid a cascading of bankruptcies due to, in the first instance, liquidity shortfalls. Without these deployed policy measures, a large share of firms, accounting for 15% of employment and about 25% of value added, would have been unable to cover expenses, with liquidity pressures pushing many of them into bankruptcy. Thus, these measures also protected the banking system, which entered the pandemic in a stronger position than the global financial crisis. We assess that corporate liquidity shortfalls could rise to over 7% of GDP for advanced European economies and to 10% of GDP for emerging Europe. Various policies implemented during the last few months aim to address these shortfalls, including wage subsidies, direct grants, tax and payment advantages, and other policy actions such as repayable advances, guarantees, loans, and equity. These measures, together with continued access to credit, have addressed to a significant extent the liquidity needs of the corporate sector. Indeed, we assess that these actions could address 4/5 of corporate liquidity shortfalls in advanced European economies and 2/5 in emerging Europe. However, we think that the ability of the announced policy measures to curb the increase in solvency risk appears more limited. This is because most corporate aid schemes were designed to help firms fill their liquidity deficits rather than to provide equity support. Indeed, while we assess the equity shortfalls in Europe to have risen to about 1.5% to 2% of GDP, the announced policy actions would fill only about 1/3 of that shortfall in advanced economies and 1/4 in emerging European economies. To preserve firms during and after the pandemic, policies made us need to refocus on strengthening firms' capital position, particularly of small and medium-sized enterprises. Preventive restructuring frameworks would enable viable corporates in financial difficulties to continue business, while enhanced bankruptcy procedures would facilitate the orderly exit of non-viable firms. Consideration could be given to recapitalization measures. These include common equity, preferred shares or hybrid capital instruments with adequate safeguards and a clear exit strategy. Consideration could also be given to debt restructuring, for example, debt-to-equity swaps. Governments could also encourage equity infusions from private investors. Let me now turn to the role that policies should play in the recovery. After the record contraction in the spring of 2020, a recovery is underway. The speed and strength of the recovery is nonetheless subject to large uncertainty. The second wave has resulted in renewed stringency measures and lower mobility. At the same time, the prospect for safe and effective vaccines look brighter in spite of remaining uncertainties about how they will be rolled out and how fast such rollouts will occur in different countries. Amid such uncertainty, though, strong policy support should continue to protect lives and livelihoods. This will limit not only the short-term impact of the crisis, but also reduce scarring, the persistent damage to the economy's supply potential. Scaling back policy support prematurely could lead to a wave of bankruptcies and widespread social hardship. Fiscal policy needs to continue providing broad-based support during the second wave. Where policy space is limited, policies will have to focus on the most critical areas, but international support can help expand policy space. The Next Generation EU initiative is also expected to mitigate long-term scarring and strengthen aggregate demand during the recovery. Continued monetary and macroprudential policy accommodation will also support the recovery. Policy rates should ensure that borrowing costs remain low and credit conditions supportive. Asset purchase programs should continue to reinforce the accommodative impact of low policy rates. Their size and competition will need to be tailored to protect the credibility of monetary policy frameworks and anchor inflation expectations. Once the recovery becomes well entrenched, policies will need to transition from providing lifelines to supporting firms with good post-pandemic viability prospects and help transition workers from sectors that may permanently decline in the aftermath of the pandemic to those that will expand. Countries should, for example, encourage only viable firms to take advantage of policy support, while facilitating the exit of non-viable firms, strengthening bankruptcy procedures, and ensuring implementation of credible reduction strategies for non-performing loans over the medium term. Job retention schemes will need to be made better targeted towards jobs in viable firms. Specifically, measures promoting job search, enhancing training and reskilling programs, and providing carefully targeted hiring subsidies will be needed alongside stronger social safety nets. Fiscal resources that will be gradually freed from temporary support should be redeployed to accelerate infrastructure investment, especially on digital and green technologies. This will provide a boost to aggregate demand, help increase productivity and potential output, and place Europe on a path towards a greener and more sustainable economy. Measures to tackle rising regional disparity and inequality will be needed as well. In particular, to support those that were disproportionately affected by the crisis, such as women, the young, the less skilled, and the less educated. Finally, the authorities will have to start preparing plans to rebuild policy space and tackle the public and private debt overhang so that they can be implemented once the recovery is firmly established. To conclude, Europe's policy response to the pandemic has been unprecedentedly strong, multifaceted, and also very successful in preventing large output and job losses. The battle is not over, and we need to continue the extraordinary policy response to support activity and facilitate transformation to the post-pandemic economy. Such policies will help cement 2021 as the year of recovery and exit from the pandemic. Thank you very much.